What's going on, everyone? Welcome back to the third episode already of Finance with Parks. Thanks for joining us. Today is going to be the third episode on the Home Buyers series. And today you notice we're putting away the PowerPoint presentations and we're actually going to go through the legitimate payment calculator or payment sheet we were given by the seller's agent for our particular unit. So this is probably the most important paper we got throughout the whole home buying process, and I was really impressed with how it broke everything down in things that were easy to understand. I understood how the math kind of calculated and how these numbers flowed together. And so what I wanted to do was just kind of screen share here. I've got my calculator up as well. Not going to try to bore you too deep with the numbers, but I'm kind of just walk through what each of these line items represent, how maybe just some details behind each one, and if I need to do some calculations on the right here, I'll do so. So the plan is I'm going to try to keep this video under 15 minutes because I could really spend a lot of time on this, and there's actually going to be two parts, maybe even three, because I'm only showing a very small section of the calculator itself. So we'll kind of get through each line item individually, and then I may end up doing one kind of summary type video with all of the line items shown at one time, kind of talk through maybe the relationship between the whole sheet. So with that, we'll get into it, and we'll start right there with hopefully the most obvious one, right? The sales price. So the sales price, $313,000, that is what you would be agreeing to buy the home. And once you agree on that price, keep in mind that that should not change, right? Once you agree on the home value, that is the principal that you're going to end up paying back. Now, don't get that confused with interest, which we'll talk about later, because at the end of paying off your loan, you will have paid much more than $313,000. But as far as the actual principal that goes towards the home price, that once you agree upon that should not be changing. So second would be the down payment. So now here's kind of what causes a lot of the rest of these numbers to be relevant, right? In an ideal scenario, sales price, the $313,000, if we had that in the bank, we could go pull that out of our checking account, give that to the seller's agent, boom, $313,000, the house is paid off, it's ours, we would have the full title. When we went to sell that house, we would be able to collect the entire payment and not have to give anyone else money, right? It would be ours outright. Well, the problem is obviously we don't have $313,000, unfortunately, and there are some people who buy homes in all cash, and more power to you. We are not in this scenario to do so, and a lot of people are not. So what do? You would go to the bank and borrow money. And just to back up for a second, I apologize, but I'm going to keep this very simple and high level. There's probably a ton of details you could go into, things like, FICO scores or loan types, but I'm going to keep it very simple, mostly because I'm just talking through my understanding. I didn't get too in depth. I admittedly had to read this 5 or 6 times, but I'm just trying to keep it simple, and honestly, a simple understanding of this is really all you need to get by. So, skipping back now to you would go to the bank to borrow the money, and that's what we're going to end up doing. However, there is going to be some amount of cash we're going to put down towards the home price at the very beginning, right? So of that $313,000 for these calculation purposes, we said we were going to put $14,000 down. Keep in mind that is the amount that's just going towards the principal or the down payment. When we go to close or when we go to collect our keys, we're also going to have to pay closing costs outside of that. So you'll see as we get further down the sheet, the number that says I think it says cost due at closing will be this $14,000 that we're putting as our down payment, plus all the additional closing costs that you have, titles, fees, things like that. So keep that in mind. If you tell them the down payment amount, that may not include closing costs. So make sure if you're telling them $15,000, you're probably going to have to account for another $7,000 at closing as well on top of that initial down payment amount. All right, so then interest rate. So keeping interest rate real simple, the way I like to think about it is, and this would be in home buying, car buying, right? Anytime you have to borrow money, it's essentially the tax or the fee that the bank is going to charge you to borrow that money. That's really what it comes down to, right? So if we had a $313,000 sales price, let's just do some math over here. We'll keep it in full numbers, but $313,000 minus the 14,000. All right, so we're going to have to borrow. If we're keeping those numbers simple, we're going to have to borrow $299,000 from the bank. And they're essentially saying on a yearly basis, based on how much money we have outstanding in the loan, they're going to charge us a 3% fee to borrow that money. So if we're keeping math simple, let's say at the end of the first year, we borrowed $299,000 and we didn't pay any of that money back. That's not a real scenario, but it's just to keep the math simple. So how you would calculate that is what you would owe in interest is going to be this $299,000, or in my math, the $299 times this 3% you put into decimal form, so times 0.03. Boom. That's what you would then be charged in interest is $8,970. So that would be the additional money. Your $299,000 is what you started with, but now you own $8,970 just for borrowing that money from the bank. So keep that in mind. This interest rate is probably one of the most important things you can negotiate in home prices because 3% really adds up in a hurry. And so let's just do this in full dollars because it's probably a little easier to see the impact. I was trying to use that for simplicity, but let's do the full impact times 0.03. There you go. It's still the same number, but $8,970 just to borrow money. So it's not an insignificant amount of what you're paying in interest. So that's why you would hear the argument from a lot of people that when you go to buy a house, obviously the more cash you can put down, the more down payment you can put towards that principal, then the less money you have to borrow, and in turn, the less money that you're going to end up paying interest on. So hopefully that makes sense. From a loan term perspective, it's normally put in 30-year terms. So if you do obviously just to check, 360 divided by 12, because it's in months, there you go, there's your 30 years. So normally 30-year loans are standard with houses, and but just another plug there, that's one thing that would be a positive about getting a 15-year loan, for example. If what you're telling the bank is essentially, we're going to pay off the loan value, or in our example, we're going to pay off the $299,000 we borrowed in 15 years versus 30 years. So hopefully it would be intuitive, though, that the flip side of that, if you went to a 15-year loan, your monthly payment is going to be much higher because you're paying off that total $299,000 in a shorter period of time. The positive is, though, that you would end up paying less interest in the lifetime of the loan. So just a quick plug there, and I'm not going to show it here, but online there are what I guess would be like payment calculator type things, and you can see over the life of the loan based on your terms here, based on interest rate, based on loan terms, you can see, hey, a $299,000 loan, I would end up paying $100,000 in interest, $150,000 in interest. I'm making up those numbers, obviously, but you can use calculators like that online to kind of see how those terms impact what your monthly payment would be and what kind of interest you would be paying in the life cycle of the loan. So the loan type is conventional. I'm not really going to get into that because I would be making up a lot of stuff, honestly. But I know that's the standard loan type there. So if anyone has anything to add on that would be appreciated, but I'm just going to leave that at conventional because that's the standard. So the FICO scores, it's essentially your credit score. And for those of you that haven't heard about credit scores, it's essentially, the way I like to think about it is the score or the rating the bank gives you as far as your trustworthiness to borrow money. I think that's the best way to think of it. It's essentially a score. It normally ranges from 400 would be really poor to 800 is excellent. And it's a rating that a lot of the banks and lenders will use to figure out, okay, is this person trustworthy to give this money to? And back to our example, if we do give them $299,000, can we expect them to make their payments on time? Can we expect them to pay off the total amount? And will we have any issues with them missing payments? Things like that. So that's what the credit score is for. So if you think of it in terms of giving money to your friends, if there's somebody that you wouldn't loan your money to, or you would be very nervous, would take your $100 that you give them to borrow and never pay it back, they're going to have a poor credit score. They would be closer to the 400s, right? If you had a friend that you gave $100 to and knew was going to pay you $100 the next day, they would have a high credit score because you trust to give them money. And so what this means in our scenario is when they're calculating kind of these terms here, such as interest rates, things like that, you get a lot of benefits if you have a good credit score because the bank isn't taking as much risk to loan you money. So hopefully that makes sense. But yeah, so what this calculation was basically saying, okay, we're going to assume you have great credit. And so in turn, we're going to provide kind of a lower level interest rate and things like that. If you have bad credit, you may not have access to those kind of interest rates because the bank is taking on more risk to give you the money to buy the house. All right, so the loan amount, sorry, totally jumped ahead. I've used that number 5 or 6 times. It's kind of hard not to because a lot of the money or a lot of the line items here kind of tie to that. But that would be the loan amount we calculated earlier, right? The $313 minus your down payment. So here's what we're taking from the bank. Okay, so then the tax rate. So the tax rate is actually the property tax rate here. And Texas is notoriously high for property taxes. And in the next video, it has the total number calculated. Let's see, I'm just going to skip down here. All right, so it's $436 a month for property tax. So that's what's highlighting the tax rate. I'll leave that for the next video. I don't know why it was separated like that, but that's what that one is calculated. All right, annuals, homeowners association dues. So HOAs. This is what I talked about in the first video. The HOAs with the townhomes, pretty expensive. Ours was quoted at $210 a month. So I guess now that we're just doing calculations, let's check and make sure that's true. If I could type correctly, so 2520 divided by 12. All right, there's your 210. So that's what we'd be paying a month in HOAs. It ends up being $2,500 total for the year, or how that would be yearly. Obviously, we would pay that the entire time we lived there. So that's kind of unfortunate, right? I mean, it's one of those things that we decided was worth paying for. They do a lot of the maintenance and the yard work for us, but that's a cost that, oh, here's something I want to clarify, right? So this $299,000, that's going to be money we have to pay off towards the principal or towards the $313,000 sell price. We're also going to have to end up paying the interest that's associated with the borrowing that money, right? But these HOAs, that's something we're never going to see again, right? That's essentially a straight up fee outside of the sales price here, the principal we're paying for the house. That's just a straight up fee that we will not see that money again, that we're paying outside of the, we'll say, the core payment to the house. So enough on HOAs. Moving down here, homeowners insurance. So I think the townhome actually does require us to have the homeowners insurance. I'll have to make sure, but I'm pretty sure that's why they include it in here. And it ends up being $50 a month. I think right now in our apartment, we pay like $12 a month total, and I think that insures Melissa's ring. So it is kind of a step up, $38 extra a month and $600 a year. But that's what that's for, right? And that would cover the house. That would cover the home in case something happened, if it like got broken into or stolen. I'm not sure if that would cover the exterior, because I assume the HOA covers that. That may be something I have to check, but they do require you to get homeowners insurance so that if anything does happen, it would be covered. All right, now the incentive for using Green Brick Mortgage. This is where the townhomes, I don't want to say get you, but they have lenders, or I guess banks is the easier term to use, people that will loan you money to buy the house. And so what they do is they want to give you incentives to use their lender because then they end up getting the interest, right? So there is a big incentive for them to try and lure you to use their financing partner because then they end up getting the interest in the long run. So what they put here is they give you an extra $4,000 if we use Green Brick Mortgage. Now, you could go out to any bank, right? Wells Fargo, Chase. The one I use here is Texans Credit Union. So what you would be comparing essentially are interest rates. Who could get you the best interest rate? And if Green Brick Mortgage, in our mind, if Green Brick Mortgage ends up being close or competitive from an interest rate perspective, it's something to consider because they do give us an additional $4,000 for using them. All right, so on to the last one here, the down payment percentage. So that is just straight math. That's up here. I'm assuming it's the 14,000. Actually, I know, but I'm going to calculate it up here anyway. Divided by the 313. There you go. So keep in mind, again, it's going to put it in decimal form. So in order to put it in percentages, you either just read it off 2 spaces over to the right, 4.47, or multiply it by 100. And now you got your interest rate, your down payment percentage, so 4.47. So the only thing, I'm going to end it here because I know that was a little long, so I apologize. I love talking about these things and breaking down these numbers, but for the down payment percent, this is where, when we talk in the next episode, the lenders like to see 20%. They want to see that you can come up with the cash to put down on the house of 20% of the sales price. Now, in our scenario, in this calculation, if we only put down $14,000, our down payment percentage of that sales price is only 4.47%. So we'd have almost a 15% delta to go to be able to put down money that would get us to that 20% margin. And because we can't get there, what the bank does, unfortunately, is they're going to charge you an additional fee, essentially called mortgage insurance, until we get to the 20% down payment percentage, or how much of that principal we've paid off versus the sales price. All right, so we're going to end it there. Hopefully that made sense to everybody. If it did not, please feel free to email me or comment below. As always, we appreciate you watching. Next week, or I may end up posting this again this week. We're going to go over the second half of this sheet, and then, like I said, we'll go from there, see how far I get. But we appreciate everyone watching, and we'll talk to you again soon. Thanks.